was reading your note and very intriguing and interesting concepts there. But tell me, the takeaway for me was the fact that you think that we are in an Amrit Kal for India. We're perhaps in a Goldilocks moment. Explain to us, why do you think so?
Yeah, hi, good afternoon to you and good afternoon to the viewers. I'm sure in Tikona Capital, basically, we are a SEBI registered investment advisors as a SEBI registered research analyst. So yes, you have brought in a very intriguing point as such. In our note, basically, we have come out with the fact that, so basically this note has come up as a thought primarily because we have been getting a lot of questions from our clients as well as the participants saying that whether we are in an uncertain period where the QT is kind of looming. We don't know whether recession is coming in or when it is coming in or how kind of severe it is likely to be going in. And they have been calling it as an uncertainty. So yes, to give you some background, what we are seeing is that India has corrected much lesser as compared to many other markets. If you look at the larger developed markets, they have corrected almost 30-35% from their peak, as well as they have gone down to June lows, as we saw at the end of 30th September. But India remains a bit of a decoupled as far as the numbers are concerned, while on the trade basis, we will definitely not be decoupled immediately, but there are some signs that are coming up. So coming back to that concept of whether this is a risk or is it an uncertainty. So we kind of went back and tried to see whether this is an uncertainty or an unknown risk which has cropped in.
Right.
Sure. So,
right.
So there is definitely a very good analogy that we could find out behind that as such. Yeah, Pankaj, you had some questions.
Right. Anisha, I think you might not be knowing that Sumit started his career with capital goods and IT. So let me start with capital goods. Sumit, after 10 years of, or rather 20 years of covering capital goods and 10 years of really not looking at it, do you get a sense that ABB, Siemens, L&T, various other power companies, infra companies, this is the space where there is a lot of earnings potential?
Definitely, Pankaj. I mean, the spends definitely have taken a bit of a turn as compared to what used to be in the past. So while I had been covering capital goods at that point in time, that was largely a power-driven capex. But today it is more an industrial capex and maybe the smaller size capex, which is more of an automation, process industry, and maybe a bit of a digitization, or for that matter, in areas of food processing, in areas of chemical, in areas of pharma. That is where the larger capex is picking up, and especially when PLI scheme is coming up, we are seeing bouts of capex in these areas. So while the capex that we had seen at that point in time is quite different, whereas the capex that is happening currently is totally different. But more so once these capex kind of comes in place, I think globalization is something which is a big theme that can be beneficiary of this part, within which manufacturing is definitely one which is playing out quite well. So I think we need to look at these capex stories, but at the same time, even the second level order impact that could be there, which we are already seeing, rather it be in chemicals or the companies which are scaling up at the global level despite the recessionary fears that are coming in. While there could be some slowdown as far as the growth expectations for the next 2 to 3 quarters are concerned, but they are definitely gaining market share compared to China, compared to many others in the trajectory. And that these uncertain or maybe unknown risk periods are likely to bring in the valuations to levels which can be quite attractive as such in my view.
Also, could you talk to us about IT? Generally we don't see IT stocks falling more than 20-25% from the high because of the balance sheet, the sort of communication they do to the market. What is the sense that you get with large cap or mid cap IT? You think it's time to look at some of these names?
Pankaj, see, what is happening is I think domestic stories are looking much more attractive as of now, given the narrative of global slowdown as such. Nonetheless, IT stocks valuations have corrected quite a bit from the top as such. And similarly, these businesses are not something that are going to topple out in a very recessionary period. They have already seen the downtick of 2000s as well as 2008. So they are unlikely to topple out, but at the same time, maybe a long-term investor should definitely look at that, depending on how much he or she already holds in their portfolio. But at the same time, yes, let this recessionary period get into a known period as far as the IT sector is concerned. So as of now, we are much more bullish on the domestic stories where the unknown risks are a bit lesser as compared to the global businesses.
Sure, Sumit. So give us the examples and instances of these sectors and stocks that you have spotted in terms of your multi-decadal theme. I know you have laid out the 6 multi-decadal themes, but in terms of stocks, how do they convert?
So yeah, definitely. I mean, see, the 3 themes that we are preferring as of now are largely financialization, formalization, and consumerism. So within financialization, if we look at large private banks, and within large private banks, stocks like ICICI Bank still come out as a winner as such. Because what is happening is they are investing a lot as far as digitization is concerned. And it's not just about investing in digitization, more so it is about investing in ecosystems. So they have been kind of at forefront of ensuring that ecosystem banking is in place. And that is why they are likely to be the winner as far as the private banking space is concerned. Similarly, AU Small Finance Bank, despite the valuations, I think they have a good leeway as far as the growth runway is concerned. Similarly, on the consumerism side, I think QSR, or for that matter, even footwear, apparel, seems to be a quite attractive space, primarily given the fact that once we cross a per capita GDP of $2,000, which we have crossed in the past 2 years, incremental spendings as far as discretionary is likely to see a much larger growth. And what is happening with these retail guys or QSR apparel guys is largely that tier 2 economics are far better than what it was in metros. Tier 2 economics in terms of footfalls, in terms of rentals, in terms of consumption demand, which is kind of picking up. And possibly the COVID has changed the dynamics where the lot of migration that used to happen in tier 1 or metro cities is largely staying back, or for that matter, most of the people have been able to get the working from home in tier 2 cities. And similarly, formalization, definitely we are seeing GST numbers going up. That is largely because most of the businesses which were in informal sector have to get converted into formalization. And largely beneficiary of this particular theme is building materials and even the ones which I mentioned earlier, either it be QSRs or for that matter, footwear and apparel. So all these themes definitely are likely to play out well over a couple of quarters, as well as a multi-decadal theme.